Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you joining me here on the East Coast. We also want to say good morning to those of you joining us from the Central Time Zones, the Mountain Time Zones, and the Pacific Time Zones. Of course, if any of you are joining us from across the pond, parts of UK or parts of Europe, good evening to you. And of course, good early morning for those of you who might be joining us from parts of Asia or Australia as well. Welcome to today's webinar titled Don't Be a Victim of Market Indecision. Today we're going to discuss some comparisons of where you might be on some of your current positions and also give an alternative for something that may or may not, depending on how the numbers come out, work out for you a little bit better. Of course, my name is Mike Shepka. I'm the Director of Education here at Power Options and Radioactive Trading as well. And it's great to see you all here. Now, many of you are familiar with the concept of the radioactive trading techniques. When we look at radioactive trading, a way to control risk, not assuming controlled risk in the way of a stop order or trailing stop, but control risk on a position so that we're guaranteed not to lose more than 4 to 6% on any position. And we're still able, I should say, to take advantage of further upside or do many of the different option strategies and options plays you're doing right now to better the position, decrease the maximum risk, and earn extra profits as well. We'll talk about that in a little bit. Now, if you're not familiar with radioactive trading, very quickly, the radioactive trading techniques were developed by Kurt Frankenberg about 15 years ago. He had spent a couple $1,000s to learn how to trade covered calls and spread positions. And then he went out on his own after 2 days of learning, of course, for a couple $1,000s for 2 days of learning how to trade options. And in the first few months, he ended up basically losing everything that he had set aside just following his guru's advice on how to handle covered call trades and spread trades as well. But he didn't give up. He realized that the money that he lost didn't disappear. Someone gained value out of that, and that he realized that, of course, the only way to really be successful long term was to actually control the risk rather than focusing on a set return that capped the upside in some strategies or spread strategies that maybe took a 10-to-1 or 8-to-1 risk-reward ratio where one loss would wipe out 10 or 12 previous gains. So what he developed is an initial structure on opening a position to control the risk, to control the losses, essentially stacking the market odds in your favor, but leaving the upside open. Now, every radioactive trade that we open consists of a stock and put combination done a little bit differently. This morning, January 24th, 2017, if I was going to open a radioactive trade on Health Equity, HQY, I might have bought 100 shares of stock today at $47.25. And then I would have considered buying the June 50 put for $6.50. Now, right away, this looks expensive. It's more than 10% of the underlying security, so I increase my total cost basis to $53.75. But for paying for that put, which is $2.75 in the money, of course, but the fact that I bought a 50 put means that even if the stock falls down to $40 per share, $35 per share or worse, I'm guaranteed at any time between now and June to get $50 back. So the most I'm risking or could potentially lose on this position is $375 or 7%. Now we look at the profit and loss chart of this position. It is a married put position, a protective put. But we do it in a different way that puts time on our favor and time on our side. Many of you might be trading option strategies right now, maybe covered calls or maybe spread trades, where you're using weekly options or options that are just 10 or 15 days out in time, for example. And of course you're doing that because you realize that you get a better annualized return if you're selling premium, and you're selling premium month by month or week by week. You get a better annualized return that way than if you're selling it 6 months out in time. But the reverse is true for options buyers. When you're buying calls or puts, or whether you're protecting positions, if you buy a put that's further out in time, let's say 5 or 6 times out in time, 5 or 6 months out of time, you're not paying 5 or 6 times the cost. You have a lower annualized cost buying further out in time, and also the time decay is less rapid. But let's take a look at this position. Remember, my investment with buying stock today at 47.25, buying that June 50 strike put for about 650 would have put my cost basis at about 53.25, I believe it was, or 53.75, my apologies. Now, that is the break even, which is shown here on the chart. This is at 53.75. But the break even only occurs at expiration. That's what the blue hockey stick graph is showing us. If I held the position all the way to June expiration, I made no adjustments, accepted no dividends if they were available. Yes, I'd need the stock to be trading at this point. But the curved line is showing you the halfway point. You see here we only probably need the stock to be at $51. But the initial setup we use for the protective put, for the married put position done in the proper context, not only keeps our risk to single digits, not only gives us 5 or 6 months of protection, but it puts us in a delta positive position. So if the stock moves up 50 cents tomorrow, we'll still have a 30-cent profit on the stock and the put combination. We could liquidate the stock and liquidate the put. That's not our goal, but we're not down $3.75 right away. We're also not down, of course, the $6.50 we paid for the put. In fact, that put's not going to go to zero until we hold it to June expiration. It's still retaining most of its value. Now, the unique setup puts time on our side. If I bought a short-term put, which is probably taught at your broker, or if you've read any free information online that if you wanted to do a married put to protect your stock, of course, that you'd look to buy a stock today, and maybe you'd buy a February 40 put in our example for HQY, and maybe pay 70 or 80 cents. Well, that only protects you for about 25 days. And in a lot of cases, it still takes on a higher risk because stock needs to drop below 40 before that insurance kicks in, and you still have the cost basis. By buying it further out in time, we avoid the rapid time decay as well. That put's not going to go to zero. It's not going to go to $4. In fact, if I had opened that position this morning and bought that June 50 put for $6.50, I could turn around and sell it right now for probably $6.40, $6.45. All I'm risking is the bid-ask spread. And of course, going slightly in the money, we're paying more up front, but we're paying less time premium compared to the at-the-money option. If I just bought the 45 right now, I pay a higher price with the in-the-money option, but the time value of $3.75 is lower than what I would pay for the June 45 put right now as well. Okay, but we're here to talk about market indecision. How to avoid some of the things that can happen to us, which are actually worse than our worst fears. I wouldn't say worse, but let's talk about what happens when a position is profitable. Whether you own stock or whether you own a long call, or maybe even if you're in a covered call or a spread trade, what do you do if the position is profitable? Okay, well, we have some decisions to make. I'm sitting on a stock that's maybe up 10 or 12%, or I bought a long call that in that case might be up 30 to 40%. Do we close half or part of the trade to take some of the profit and lower our cost basis? Do we liquidate the trade, take the profit now, and avoid if we have any market indecision, if we don't know really what the market's going to do next and we're hesitating? Maybe we'll sell a call against the stock or roll the covered call, or maybe you'll sell a call against the long call, sort of creating a calendar spread. Or would you buy more, adding to the further upside? And of course, the other choice is, well, we do nothing. Or maybe do we put on a trailing stop now, but if the stock gaps down for some upcoming event, the trailing stop only helps us if that's done during the market hours. If it happens in the pre or after market hours, we could still realize a significant loss with that in place. But before I ask that question, I'm just curious, what kind of option strategies are you trading right now? Are you mainly just looking at stock and ETFs? You're not doing any kind of options trades or very limited options strategies. Are you focusing right now on covered calls or naked put positions? Are you doing buy calls, or buying calls, buying puts? Maybe doing straddles or strangles around earnings? Are you doing the credit spreads or the debit spreads, or are you doing more of the combination spreads as well? I'm really going to leave this poll open for about a minute here. All right, so we've got about another 15 seconds or so on the poll. Most of you have voted. I appreciate that. Not exactly the results I expected, but we do have representation in every group, which is fascinating. All right, let me go ahead and close the poll, ladies and gentlemen, and I'll share the results with everyone. Now, 20% of you are doing just stock and ETF positions. 30% of you are doing the covered calls and the naked puts. Only 5% of you are buying calls and buying puts, straddles, or strangles, mainly is your main portion there. 35% of you are doing credit spreads and debit spreads. 10% of you are doing diagonal spreads as well. Okay, so we might have a little something for everyone here. Let's go ahead and hide that poll, and I'm just going to follow it up real quick based on what we just talked about. Now, how would you manage a gain on a stock or maybe a long call position? Covered call might be slightly different if it's moved up and you're going to be assigned. But if you had a gain on your stock or ETF, didn't have anything else open on it, or you just had a long call or a long put that shows a gain, what is your typical approach for managing that position? Would you liquidate the stock or the option? Let's say it's 10%. Let's say for the long stock, it's up 10%. And let's say that your maybe long call or long put's up 30%. Okay, would you liquidate it and take the gains? If you had multiple shares, would you sell half of the position to reduce the cost basis? Would you sell a call at a higher strike to reduce the cost, whether against the stock or maybe against your long call? Now, would you add more shares or contracts with some call doubling down, of course, or some call laddering? Or would you do nothing, maybe hoping just for further upside? But sometimes you see the stock move against you or the long call pull back, and what was a locked-in gain or what was a strong gain could end up being a loss. So just let me know what you think about how you would manage one of these positions. Okay. All right, I'm going to go ahead and close the poll down here. All right, David, I'm going to have to handle that question towards the end of the presentation. Mike, yeah, I'll talk about that in a minute. Let me close the poll and share the results here just to get that down. 35% of you, okay, said you'd liquidate the position, take the gains. 25% of you would sell half, reduce the cost basis, maybe, and of course still have half the position open to realize extra profits. 35% of you would sell a call at a higher strike to reduce the cost. And 5% of you would add more shares or contracts, kind of in the double down or what's sometimes called the laddering feature as well. Okay, and Mike says didn't offer the married put. I know, that's what I'm showing to sort of the new people here as an alternative. And we're going to walk through that. Okay, and David, I'll have to get to your question later after we discuss some of the ideas here. Okay, all right, so let's go ahead now, see where we are. There we go, perfect. All right, so there are many trades, of course, and many ways on managing the position, and we've all been here before, where having a gain on a position can be frustrating because of the different things that we can do to either continue the trade or to manage the trade. Now, we should be lucky every time. Having a unrealized gain or a stock that's up in price or a position that's up in price and profitable is, of course, always better than having a loss. But is there really a best way to manage a gain and avoid this indecision of what to do next? Well, Every situation's a little bit different, but let's go ahead and take a look. Now let's consider health equity one more time. Now, earlier I showed how I would open a radioactive trading position that might be opened on HQY today. With the current prices in the market, controlling my risk to under 7%, realizing that that 7% loss could not be fully realized unless I held the position all the way to June expiration, and I have several months to make adjustments, lower that risk, and eventually cancel it as well. Okay, but let's go back. Let's go back and take a look at HQY back from December 13th, 2016. Now on December 13th, HQY closed at 41.86. It was up about 85 cents on the day. So about a month and 10 days ago, about 40 days ago, we could have taken a look at HQY and bought the stock at around 41.86 towards the end of the trading day. As we saw, the current price this morning at around 10 a.m., 11 a.m. was 47.25. So we have a gain there of $5.39 or 12.8% of what we might have invested in the position. Now, during that same time, I had mentioned this in the email last week and then in the one again you saw today. SPX is at near highs over the last several months. We're currently at about 22.68 this morning. Now, on December 13th, the same time we could have got an HQY at 41.86, the SPX was at 22.71. We could say that SPY was at $227 and about 17 cents. And we've had some dips and some movement, but we haven't really seen a rising tide. We've seen a lot of hesitation here. And of course, the other problem with this is that we're right in earnings season. So looking at this chart, 33% of us might say, well, I think SPX, SPY, the broad market is going to stay neutral. Another 33% might say that, well, if I looked at some of the more technicals and everything else, I'd expect SPX to gap up. We've had this stagnation period, this little hesitation. I expect it to jump up. And others might look at it and say, well, it hasn't been really showing us any gains or any real strength. I feel this is time for a correction. So in that in mind of what the broad markets are surrounding us, a third of us would probably answer this question in a different way. You know, a third for each kind of section, then what could happen next? We just don't know. But what do we know? We can take our positions that we have right now that have a realized or unrealized gain, and we can take action. So let's say we're in HQY with an unrealized gain of 12.8%. Here's our market indecision. What do we do now? Do we close now and take the gain? Do we close half of the position to reduce the cost? Would we sell a call at 50, generate some income to lower the cost basis? Could we add more for further upside? Or we do nothing and hope and pray, or something else? Well, let's take a look at our common ones. Okay, now what else do we know? Well, we already talked about what SPX has been doing, how it's been flat, it's near new highs, maybe due for a correction, maybe due for a breakout, we don't know. But we can also see that if we're in our stock, we've got earnings coming up on February 6th, roughly 13 days away. So if we're concerned about what might come out of those earnings, well, if we close now, we could just simply take the gain. If we closed at around 47.25, around 10.15, 10.20 this morning, we'd have that profit of $5.39 per share, or 12.8%. That's pretty good for a 40-day trade, not too bad at all. But if the earnings are positive and the stock gaps up another 10, 12, 15%, we miss out any potential upside by selling now. That might not be too bad. Still happy with a 12.8% gain. Okay. What else could we do? Well, we could close half to reduce the cost. Remember, we'd purchased 100 shares at $41.86, so our total investment would have been $4,186. If I sell half now, I close 50 shares at our $47.25, we could take in $2,362.50. So our remaining cost basis on the stock, of course, is going to drop down to $36.47 per share. That's not too bad. We have an unrealized gain in the position. But what if earnings really disappoint and our stock drops about 20% from where it is now, 25%, and falls below $35 per share? Well, we'd be looking at a loss when we could have taken in the large gain. Okay? What about selling a call? I'm sorry about this. I didn't write over all of the slides I meant to. So this is HQY, of course, not Apple. That was from a presentation back in December. But let's take our own shares of HQY at 41.86. With the stock up to 47.25, we could sell the February 50 call. The stock doesn't offer weeklies. And it doesn't offer 2.5 strike differences, because I'd be very tempted to sell the 47.5 rather than the 50. But the 50 has a good premium. It's at 90 cents. So we could take our cost basis down to 40.96. That's our new break even. And if we get assigned at 50, we could make $904 off of now our investment of $4,096, which would be a 22.1% return. Okay, that's a hefty profit, but there's nothing beyond 50 unless we put in more cash. If the stock gaps up, from where it is now, that 10, 12, or 15%, we don't make anything more. Of course, 22% is nothing to bat an eyelash at all, is it? That's a very strong return, but we don't get any more upside. And remember, that profit is not guaranteed. That's the max profit if the stock is trading above $50 per share. It's not a guarantee that we're going to go ahead and make that profit. Okay? Now, adding more can result in a higher monetary return, but it also could result in lower percentages, of course. We have our original 100 shares at 41.86. Say we went high. We bought an additional 100 at 47.25. So our new cost basis per share would come out to $44.55 for 200 shares. We'd have about $8,910 invested instead of $4,186. So the profit, if the stock moves up to 50 on February 6th after the earnings, okay, would be $1,090. So that's 12.2%. Now it's less than the covered call percentage-wise, but remember the upside is still open if it moves further. And the downside is open as well. What if HQY now drops below 44 per share? We'd have a loss on the position by adding more. Okay, Han says that he's not seeing the screen. Han, it does appear that the screen is coming through. I haven't seen any other issues about the slides not showing up. You may need to log off and then log back on. Jeff says that he sees it. Jim says that he sees it. Tom sees it as well, Han. So if you're not seeing the screen, you may need to log off the webinar and then use that link to come back in. It might refresh the page, but the images are showing, and of course I am recording today's presentation, so the archive will come through as well. All right, now, of course, last option, do nothing. We hold the stock at 41.86. Don't do anything else to it. Have unlimited upside, but we haven't reduced our cost basis. We haven't averaged down the cost or laddered the position, and we keep the risk and the break even the same. So let's do a quick breakdown now of what we'd see. Remember, if we went ahead and liquidated the position with earnings coming up in about 14 days, we have a new cost of zero. Yeah, we took our position. Actually, it'd be a gain, of course. 539 would be our profit. We've got the 12.8% gain. And, of course, if the stock moves up to 50 from February 6th or higher, we don't make anything else. Of course, if the stock falls because of the earnings events coming up in 2 weeks, we don't make anything else either. So we take our 12.8% return, we're happy, and we move on. Now, if the stock's trading, if we sold half and reduced our cost basis to $36.47 for 50 shares, if the stock moves up to $50, okay, we had a gain of about $18.23. Oh, I'm sorry, we have a cost basis for 50 shares of $18.23. We get $2,500 back if the stock's trading at 50 for our 50 shares. So we'd have a profit of $676 or 37%. So now that we're kind of using leverage, much like in a spread trade where it looks great to make 11 or 12%, on a bear call or bull put credit spread that only has a $2 or a $5 risk, but it's got a 10-to-1 risk-reward ratio, so if one moves against you, you've wiped out 10 previous trades. But here, we have 50 shares now, so if the stock moves up, we get $676, which is 37% of the now 1,800, 3657 times 50 that we'd have in the position. And if the stock goes up to $55 per share, we'd have a profit of almost 50%, or $926. But remember, since we reduced our costs, if the stock falls down, drops to $40 per share, we'd still have a gain of 176, or about 9.5%. Doing our covered call, generating some income, lowering the cost basis. If the stock's at 50, at expiration, we get the pop from earnings, we hold it to February 17th, we'd make the 22%, $904. And if the stock goes higher, and at expiration stays above 55, we make 22%. But if the stock falls below 40 because of the earnings, we didn't sort of protect the downside, other than the 90-cent premium we collected, so we have a loss of $96, or about 2.3%. Now, what does buying more do for us? Buying more, the laddering, increasing the cost basis, well, we increase our monetary return, of course. So here, if the stock goes up to 50, we have a profit of $1,090, but of course that comes down to 12.2%. Would have been better off just closing at that point today as opposed to adding more. But if the stock does continue up, goes to $55 per share, well, we'll make about $2,100, or 23%. Higher than the 50% we made here. I'm sorry, lower than the 50%, but the monetary value is much higher. But then, of course, the risk here, shooting for a more bullish position, adding more shares, hoping that the stock's going to gap up with us. If the stock falls, comes back down to 40, we've got a loss of $910, or 10.2% on the $8,910 we have invested in the position now for 200 shares with a cost basis of $44.55. And the do nothing monetarily looks pretty good, and percentage-wise looks pretty good. 814, or 19.4% at 50, $1,300, or 31.3% at 55, but a loss of $186, the biggest loss on the screen, or 4.4% if the stock falls on February 6th. Of course, if it goes lower, all of those numbers would increase as well. Now, a question had come in earlier from Mike about what about the married put? What is another alternative that we could potentially do on this position if we still wanted to take advantage of potentially further upside, but we didn't want to give up any downside as well? Well, let's take a look here. Here we are, sitting on 100 shares of HQY at 41.86, where we have an unrealized gain of 539, or 12.8%. The other alternative, instead of course, starting the position as a married put, now that I have this unrealized gain in the position, I can lock in some of that gain by converting it into a protected position now. So as the stock moved up, of course, we know it's trading at 47.25. All of the put premiums have now declined in price as well as the stock continues to move up. So we could buy a March 50 put for $490. Now remember, our stock is at 47.25 right now, or it was this morning. So this 50 strike put for March is $275 in the money. Okay, so of this $490 I'm paying, only some of it is intrinsic value. The remaining is time value. So the 41.86 plus the 490 is going to increase my cost basis to 46.76. Now that is the highest of all the examples we saw. Even adding another 100 shares, our average cost per share into the position was only 44.55. But remember, now that we've purchased a contract which gives us the right to close our shares of HQY at any time for $50 per share, I have a guaranteed profit of $3.24 or 6.9%. Now, it's less than what I could get if I liquidated right now, but what does the structure give us? It gives us a position where we've locked in more than 50% of the unrealized gain, and we can still have unlimited upside profit potential if the stock does gap up to 50, 55, 60, or higher. At the same time, we're going to guarantee ourselves a profit no matter what the stock does next. It can stay where it is. It can fall to $42 per share. It could fall to $35 per share, and we have a locked-in guaranteed profit of 6.9%, which you can't get with a trailing stop. If I put a 50, or I couldn't put a 50, but if I put a $45 stop on this stock now, it's trading at $47.25, and it does nothing to February 6th, but the earnings come out and it gaps down to 35, my stop order is just a market order. It tells my broker that if the stock's anywhere below 45, close the position. Market opens at 35, they sell to close my shares for $35. I take a $6.86 loss on the position. Here it can drop to 35, and I'm still guaranteed a profit of $3.24. But we've left the upside open to take further advantage of that position. 14 days from now, if we hit earnings, as you can see, it can gap down anywhere. We're guaranteed that profit of $3.24. If the stock gaps up, we still have unlimited upside profit potential going forward. And there's other things that we could do as well. But the proper structure to help us avoid the market indecision of, do I sell half now? Do I add more shares? Do I liquidate now? This allows us to trade without fear. We can lock in a profit and no fear of overnight drops and a guaranteed profit, unlike a trailing stop or a stop order. We have the confidence and comfort going forward. We can sleep with ease. The next 14 days we can focus on our other positions. I know the exact outcomes of HQY. I don't have to try to force another trade, but I could do something else to further increase that guaranteed profit. And think about this. What we call being bulletproof now is that you have a guaranteed profit to the downside, and you still could win more to the upside. So it's win if you lose, win more if you win. That's a great structure to be in. There are other things that can be done to that position. Remember, we showed those of you who are interested in selling a call against this position now probably wouldn't do that with an unrealized gain if we have earnings coming up, because we don't want to cap the upside. But I could combine both. I could still generate that 90 cents against this new protected position with a guaranteed profit, and this would increase the guaranteed profit to the downside from that 320 to about 414. And if the stock happens to be trading right at 50, we could make about the same profit from liquidating right now. But as you can see, the problem is if it does gap up higher, although we'll still have a reasonable profit, we won't make as much. And why is that? Well, it's because we bought a March put at the 50 strike, and we did sell a 50 call for February, but as the stock moves up, the upside is capped by the call obligation. We're not losing money just because the put is declining, which it is. We're losing money because we've canceled the positive delta we had when we originally opened the position, or when we converted it to a married put to lock in the gains and still have unlimited upside profit potential. But we still could do that, get a little bit more guaranteed profit to the downside if we're wrong, still have close to what we'd have if we liquidated right now, about the same by adding the two together, but then we do risk giving some back to the upside. But it's still a possibility to be done once you've locked in. Okay? David says, can this strategy be used on weeklies? Of course. If HQY offered weekly calls and I knew that the earnings were coming up on February 6th, I could sell the January 27th call and maybe even the, February 5th, February 4th call against it before the scheduled earnings. But remember what I showed earlier, David. This is David P. David B. asked the question earlier about the risk, which we'll talk about in a little bit. But remember what I talked about earlier. The reason you want to buy the put in the proper structure is for those three core principles, most of which, of course, is the time decay. If I buy a weekly put or a 2-month out put, the time decay is very rapid. When you're buying options, it's better to buy them 4, 5, 6 months out in time, or even a couple months out in time, so the time decay leading into event is slower. But when selling premium against it, you can sell it, but there's do's and don'ts to that. You don't want to just sell a weekly call because a weekly call is available. Or do what we call riskless spread trades in the context. I can do bear call spreads and calendar spreads in the context of the initial married put setup as well. And what that will do, of course, David, is it won't take on the additional risk that I'd have with a bear call spread or a calendar spread or even a ratio call spread done in the proper context, but I still get the advantage of those strategies done in the proper context as well. All right, John, bear with me one moment. John just asked another question that's a little bit more advanced, I would say, but not really. It's more for the blueprint owners already, but we can show that as well. Okay. And Jeff, I'll get to that too, so give me one moment. But here's our comparison. And I'll agree with you, depending on what your outlooks are in this scenario, what I just showed you might not be the best alternative, depending on your outlook. Now remember, when we sold half, we're going to reduce our cost basis into the position, and we're going to see these sort of leveraged returns, and we still have a 9.5% profit if the stock falls to 40. But if it fell to 35, we'd have a loss, and so forth as well. But let's take a look down here. What do we see with the new structure, the new idea here of converting it? Well, if I buy the 50 put, if the stock gaps up to 50 on February 6th, we'd sell a profit of 576 or 12.3%. Pretty even to what we have there. Now the cash is higher, but the percentage is lower because remember we increased the cost basis to get that guaranteed insurance. If the stock goes up to 55, monetarily we make more than the covered call, pretty much the same monetarily as selling half, but the percentage is a little bit lower just because of the increased cost basis. But if the stock goes the other way, falls to 40, falls to 38, falls to 35, because of that event, we have that guaranteed locked-in profit. Now, I showed you a locked-in profit on the position, of course, that was a little bit different. What this is showing you is where the position would be on February 6th. All these numbers are based on February 6th, except for the covered call one. Okay? Here, if the stock fell to $40 on February 6th, we'd still have time value remaining, 10 cents, 15 cents. So the return would still be 7.1% or 330. We haven't hit the max locked-in profit yet. You know, that would happen when all time value decays. We get a little bit more on February 6th, February 7th after the earnings because our March put still has some time value remaining. Okay? Now, with doing the proper structure and adding the put in place to guarantee a profit and adding the short call, well, we see we could still have a 13.6% gain, more than liquidating right now, even monetarily, close to monetarily even to selling half, higher percentage than buying more, of course, and higher percent, no, I'm sorry, not than the covered call. But if the stock goes to 55, unfortunately, we have to give some of that back. Okay, so that's where that gives out. But if the stock does collapse, in this case, we have the highest monetary profit and the second highest percentage by adding that short call. But in reality, I'm doing this because I want to lock in the profit and still have that unlimited upside. Doing the combination of selling the call after you've added the put might not be the best combination for an earnings outlook, but it is possible, and you could do that. So what's best? Well, we didn't go further to the $60 range and the $70 range, and it's really hard to see, but although even if the stock drops to 40, selling half right now still has the highest percentage return, but the lowest monetarily, lower monetarily gain. But the only three that offer the gain are locking it in there if we're wrong. We want to be right. We want to lock in some of that profit. We'd like to see more profit if our expectations are correct. But I don't want to be in a position where I have a winning trade that turns to a loser. Now you could apply this, of course, to maybe a call position also. If you have a long call, you could add the put to it to create a straddle or strangle around earnings. We have other presentations on power options, of course, that show the straddles and strangles for earnings and different things as well. But this is another idea on what you could do to manage the position. So now, have I avoided market indecision? Well, pretty much. I've got a position that has a guaranteed profit no matter what happens next. I can still realize unlimited upside profit potential. Other than selling now and taking the gain, that's probably the best idea, in my opinion. Now, sure, selling half looks great. You've reduced the cost basis. You've got some good leverage returns. But especially if the stock pays a dividend or offers good call premium, or especially if you want to stay in it longer term, this is a much better alternative than giving up half your shares on the position. And you can still, as I mentioned, generate more. Now, what about a position? This relates to the questions that came in a little bit earlier. John had asked a question about making a different adjustment we talk about in the blueprint. I'm going to show a couple others that I could do on a position right now. And the other question that came in was, what about buying the September put now instead of the March? Well, to answer the question that came in about me saying you should buy 5 or 6 months at a time, wouldn't the September be better? You know, that said, it seems a September would be preferred over March. You're right, if you wanted to be in it longer term, Jeff. Okay, but with an earnings event coming up, being in the position, if I'm expecting a large gap, I can have that higher return by paying less money than the September and still locking in a lot of the profit and not overpaying. See, the February options are overpriced because they're going to be the ones that are most affected by the event on February 6th. The Marches aren't as bad. The Junes aren't as bad. I could have bought a June one as well, which wouldn't have locked in as much profit, but would have almost allowed me to cross through 2 earnings while still having a guaranteed profit in place. And I could adjust after any time. But let's talk about the original position. If on December 13th, I would have opened this as a married put, a radioactive trade, I would have bought shares of HQY at 41.86. And at the same time, I could consider the June, which was 180 days out in time, but buy the June 45 put at 620. Now this would be my total invested here of 48.16, which I have it here as the highest of our comparisons. The cost basis of 48.16 from the original position. Even if I average down, it would have put us at, what, 44.55. So this is the highest of our comparisons. But when we originally opened this position on December 13th, guaranteed exit of $45, which gives me a max risk of 316, or 6.6% on the position. Now again, remember, I'm not down 316 when I open the position. I'm not $316 down behind the 8 ball. I'm also not down the full cost of 650. As you can see by the profit and loss chart here, this position is at a profit. That full loss is typically only realized if I hold the position all the way to June expiration. I make no adjustments and accept no dividends. The stock happens to be trading below that price at expiration. Or if the stock really took a hit, dropped down to $30 per share, losing about 15% of its value sometime in the next 2 months, my 45 put would go right to intrinsic value very quickly if it's down near the $30 range, even though it's out to June. But again, that's a 50% drop on the stock. I'm only losing 6.6% in the absolute worst case scenario. Okay. Now, before I go any, before I go any further, let me just ask one last question. I know some of you are already doing this in your portfolio, but let me just ask one quick thing. Without even considering the adjustments I've shown on a stock that you have that has a gain in it, where you can lock in the gain, without considering doing other things in combination, think about your trades over the last year. And think about if you had just done this one simple trick about looking at a far out in time put on your position that guaranteed your losses could not be more than 4 to 6%. How would your trades have performed over the last year? Would keeping your risk to less than 6% on every position that you lost last year not have helped you at all? If you had lost last year, well, you'd still have lost, but lost much less. And if you lost last year, would keeping all of your losses you had over the last 12 months turn a losing year into a winning year? All right, Lionel, I see your question. I'm going to get to that in just a couple of moments. We're going to look at some other things there. Okay, this is an interesting scenario that we have, not too far. Okay, let's see here. Okay, so let me go ahead and close that poll. I'll share the results with everyone. Okay, so 18% of you have stated that keeping your risk to 6% or less over the last year would not have helped your trading. You either had a very successful year, and what you've been doing hasn't caused any problems for you. You maybe have a high percentage return. Well, that's great to see. Some of you are doing very well. 41% of you would have lost by just doing this one simple trick to keep all the positions to a loss of 6% or less, but you would have lost much less. And 41% of you would have turned a losing year into a winning year. Okay? All right, I was just curious about that, so let me go ahead and hide the results here and get back to what we're talking about. So on February 13th, this would have been our situation. This would have been the setup we would have chosen. Now, remember our chart. The open on December 13th, there was a large gap up there beginning in January. And of course, right now we're trading around that 47.25, 47.30. It's actually dropped to about 46.50, 46.60 during the day since I was putting these slides together for you this morning. Now, could we take that position I had, the position that was open on December 13th, and make adjustments to lock in profit and still be able to generate income and leave the upside open or profit in both directions? Well, absolutely. Let's take a look now. I'm going to jump over to Power Options. First, I'm going to show something else very quickly here. Let's go back and, sorry about that, folks. Let me go here. There we go. Okay, so let me go ahead and show the screen. What I'm looking at here is the Fusion subscription at Radioactive Trading. And what the Fusion subscription shows is there's Fusion subscribers see a series of lessons to expand upon the concepts in the blueprint. There's an open trades trade tracker where Fusion subscribers can follow my radioactive trades, Ernie's or Renner's radioactive trades. You can see new married puts based on the default criteria. There's also a stock insurance tool we're going to look at in a little bit. But let me go to the open trades here. What I want to show you is the trades that we're posting. One of the trades Ernie has is on HQY. And HQY originally opened on December 13th. Go ahead and take a look here. The setup I showed you was exactly what he did for Fusion subscribers on December 13th, 2016. He got in the stock at 41.86, 41.96, and purchased the June 45 put for 620, where he had the risk of 316 or 6.6% on the position. Okay, so that's a trade that we've been following. Now let's take a look at it on Power Options. Oops, too much going on there. Much better. Here again is the position that I just showed you for HQY. We had a cost basis of 41.86. We purchased the put, the June 45, for 620. So our total entry was 48.06. Oh, I put 41.86. That was the close of the day. Ernie got it at 41.96. Okay, but that's the 10 cents different. So the maximum risk is 306 or 6.4% in this case, what we showed earlier as well. Okay, now we talked about how if I just own the stock, I could buy the put right now and lock in the profit. But can I manipulate this position further to still lock in the profit where I started and potentially have more upside profit potential? Absolutely, there's different ways to do it. And we're going to talk about a couple of them right now. I just wanted to make sure I was looking at something correct here. There we go. Okay, so we have a 45 put that we bought in the money that is now out of the money. The stock's at 46.37, so it's not as high as it was this morning. It's pulled back a lot. But as you saw, Ernie's already bulletproofed this position by doing adjustments from December 13th to today. But what could we do today? Well, if I want to keep the insurance in place, and I still want to cross earnings with protection in line, we can adjust this put. Now, what do we know about the June 45 put? We opened it in the money. It's now out of the money. But it didn't go to zero. The 45 put that we paid $6.20 for, even though the stock is above our put strike price, is trading $3.50 to $4.20. So if we got a midpoint, we could sell to close this put for about $3.85. Okay, so we've gained $5.39 on the stock, and we've only given up $2.40 on the put. That's the positive delta. It's still working in our favor. Our put has not gone to zero. But remember what we could buy. We sell this for $3.85. We saw earlier that that 50 put was only about the March. I could roll into March if I wanted to, but also up in strike. So I could purchase this for $4.90. Oops, forgot to do something. Let me do that right. Let's sell to close our 45 put here for $3.85. So did we lose on the put? Yes, but we've gained more on the stock. And if we look at that March 50 again for $4.90, here we are at another opportunity where we have a locked-in profit as well. The position is now bulletproof going into earnings. Could I still now choose to sell to open the February call? Well, it's going to be cheaper now because the stock pulled back, but let's say we got that same 90 cents that we used for our other comparisons. So we could add that in. And this is going to take us to about $1.79 or guaranteed profit of 3.7%. Not as much as we had, but now we're still in that bulletproof position. Still can make about 8.3%. Not as good as what we could do if we liquidated right now, but remember, we're in this position from the beginning. We would have made other adjustments here where Ernie is already bulletproof to about that 1.9, 1.8% on the position going into earnings. And another interesting thing, of course, is I could leave this as is. And of course, we had a discussion here. I'm going through earnings. Maybe I could bulletproof it by doing that adjustment. Let's see that again. Let's sell our June put for $3.85. And let's look at March again. But this time, what if I bought two at $4.90? So I'm taking down the cost basis by selling to close my June 45 put, taking a loss on it. But what if I bought two March 50 or even June 50 puts, which have a higher price on the position? Now, what's interesting, this is what we call income method number 12. Yes, it's a synthetic strangle, or in this case, a straddle, in a sense. There are other ways to build this, but notice the curved red line at the halfway point. Or on February 6th, what happens if the stock stays at the same price to February 7th, even after earnings, now that we've closed out the position and we have two puts? This would be considered income method number 12. You see here on February 7th, even if the stock stays right at 50 or goes up to 50, we're still guaranteed a profit. It goes up to 55, not as high as some of the other approaches, but we can profit more to the downside now even as well. That's a different adjustment. I think what I showed you was rolling up the put was income method number 4, what we call rolling up the put. Another one, just selling the call to create that collar position. We looked at that as well, but have no risk to the downside. And then here is a different income method that's used in certain scenarios with earnings coming up, where I can still profit from the downside and still have unlimited upside profit as well. We do increase the cost basis on the position, but it's the unknown. The worst case scenario is I might only make $111 on this position after the earnings come out. But if the earnings come out and the stock stagnates, I could still do other adjustments. If it drops down to $40 per share, we're going to have a profit equal to or higher than what we would have had we just bought the stock at 41.86 and tried to lock in the profit now. Right, that was only about 312, 324. This is double. Having been in the position, we could realize more profit to the downside as well. Okay, so a question came in that I want to address. Those are some of the things that are possible. Those are some of the things we can do. It's not just about locking in the profit. And all of my positions aren't just about having a limited risk at first and trying to get it to zero. I have 12 different adjustments I can use against that properly structured setup with the guaranteed limited risk where I can generate income just as you're doing with other strategies right now, but with the known limited risk in place. And I can do those adjustments if there are some that work best if the stock moves up, as we saw today. Some work best if the stock stagnates, hasn't moved in the first 20 to 30 days from when I open the position, and some that can even work in a down market as well to lower your cost basis or to profit in both directions. But Lionel's question was, how far do you buy the put from earnings? Well, that depends on your scenario. Okay, there's different ways you can structure this. Okay, here's something I wanted to show you. We can go to Married Put tab and I can click on Insurance, just a different tool that we offer. And let's take HQY again. Let's put in my cost basis of 41.86. We use the cost basis at the close at December 13th, even though his earnings cost basis was a little bit different. And I'm going to leave it at all months, Lionel. Okay, I'm going to leave this tool to search for all months. Let's go ahead and hit calculate. Now, our return is not as high, excuse me, as it was at 11 o'clock this morning, 10 o'clock this morning. We have an unrealized profit of 11%. So we see here we could buy the February 50 put and have a locked-in profit of 7.4%. And now here's our March 50 put that we looked at, slightly different price, but it's a locked-in profit of 6.2%. As John mentioned earlier, we could go out to September to the 50 strike put or even the 55. We're not locking in as much profit, but now will probably cost at least one other, maybe two other earnings events as well. Okay, and so the question comes in, how far away do you buy it? Well, it's going to depend on how long you want to stay in the individual position, Lionel. What looks best to you? If you bought the February 50 put, you're protected. You've locked in a profit of 7.4% from the unrealized 11% you have, or you could go slightly higher with the 55. I'd keep it at the 50. And you see here, we talked about how the 45 put for February is at 165. It's going to cost much less, but you're not locking in as much profit because that insurance doesn't kick in until the stock falls below 45. So you could buy the February, Lionel, but that's if you're planning on getting out of the position after earnings anyway. That is a possibility. That's what this tool will show you. But if you wanted to go through the earnings with a guaranteed profit and this was a core holding in your account, you still wanted to hold it further, see what comes next after the earnings, we could even go out to September if we wanted to. Some of those positions, some of your stocks will offer leaps. You'll see opportunities for January. Last month, some of you joined me for this similar presentation on the comparisons of market indecision, and we took a look at Apple. So around December, what if we had bought Apple back in September, I think with a cost of 109.13 or 109.20. That's why you saw some of the slides still had the Apple text in there. Okay, so what could I do with Apple? If I had a cost basis of 109.13, I have about a 10%, even 10% unrealized gain. Well, I could buy February options, still lock in about 80% of the unrealized profit I had. But if I want to hold this longer term, I can go to June, which would allow me to cross through two earnings events essentially. And I'm still locking in 70% of the unrealized gain that I have. The stock at 119. Now, of course, at 120, we're about 4%. It's not as high. We'd want to keep it maybe at 125, where we've got a little bit more than 50% of the unrealized profit, but could still realize further upside. But we could go further out. I could go to January options on Apple, still have some opportunities to lock in a profit, not as much, but it's a year out in time, and I'm guaranteed to make 1.4%. And I have the opportunity to cross the other earnings with that guaranteed profit, and if done correctly, still continue to lower the cost basis with riskless spread trades, maybe just selling calls, income method number one, or still manipulating that put option because I've put time on my side. But we could take a quick shot as well and just go to February. That is an option, but it's based on what you think the stock's going to do. David P. brought up another question. I assume the strategy just works the same for short positions, but the opposite. That is true. You can do that as well. We don't actually advocate doing the reverse, okay, shorting a stock and then buying a call against it. There's other ways to have a guaranteed limited risk in a bearish market without taking on some of the obligations you may have with your broker of shorting stock, a margin fee, and other positions as well. We show that Blueprint owners have a webinar they can access for playing the bear side of the market with the limited risk positions, okay? Okay, David's question was a little bit different. It's more related to the actual structure. Let me take the HQY position that I would have opened today. Let me go back to the custom spread tool very quickly. There's two layers of protection we talk about in the blueprint. Okay, this is more of a question for sort of a blueprint discussion as opposed to just the introduction of an alternative of locking in your positions. But I'm going to use two layers of protection when I open a married put. So in the beginning, I showed that if I had opened this morning this position on HQY, I would have likely bought stock at 47.25, and at the time I would have bought the June 50 put for 650. Okay, so again, my total invested was 47.25, or plus the 650, I'm sorry, so 53.75, but I can't lose more than 375 or 7%. Now, a second layer of protection, what I'm going to do is I'm going to make sure that this monetary risk of $375 is between 1 to 2% of my total portfolio value. So if I'm only trading with $15,000 total portfolio value, I would just do 100 shares and one put. And this 375 here, okay, that would be about 2% of my total portfolio value. A little bit more, but that's, you know, okay, you just don't want it to go up to the 4, 5, or 6%. So I'm investing 1/3 of my total portfolio into this position. I have a $15,000 account. I'm putting out $5,375, but the most I can lose if it falls down to 375, well, that's going to be about 2.2, 2.3%. Okay, that's what I'm looking to do. So I'd only have about 10,000 left, a little under 10,000 left, so I could open more positions. And I could look for lower stock positions that match that requirement as well. When I first started, I had only put about $7,500 towards radioactive trading when I first met Kurt back in 2007, 2008. So I was looking at stocks and married puts that were trading in the $12, $14, $15 range, and eventually when I saw how it was outperforming long-term the other strategies, spread trades, calendar spreads, straddles and strangles that I was trading in my portfolio, I shifted my money and put more into it. Now I was doing $20 and $25 stocks where my risk was maybe only $1.50. So I might be able to do 200 shares or 300 shares and so on and so forth. So if I'm trading with, you know, a $45,000 account, that's the total portfolio value. You know, I could do 200 shares of this stock and that would put me above 2%, but that's kind of okay. You like to be in the 1 to 2% range for the total monetary value. Okay, but you can look for other stocks, you can look for different stocks, you can control the monetary risk with the search tools as well. Okay, so that's all talked about in sort of the blueprint and in the Foundations of Radioactive Trading CD that you receive for free, or I should say the video, the Foundations of Radioactive Trading video that you receive for free when you pick up the blueprint. But going back again, I just wanted to mention something there. We already talked about that. If you haven't done so already, after today's presentation, you can go to www.powerup.com/RAT, stands for radioactive trading. What that'll allow you to do is you just have to put in your first name, last name, and email address and you can test the tools for 14 days without any credit card. So if you have stocks that are up in price and you're worried about earnings coming up, you're worried about the hesitation we saw in SPX, you can go into the Married Put tab on your free trial, click on that insurance tool, put in your stock, put in your cost basis, and you'll be able to see what puts you could use to potentially lock in profit right now, minimize the gains, and then you could use the graphing tool, the custom spread tool, to see how else would the trade look if you added a short call or maybe a riskless spread trade or other positions. Now I've thrown some numbers at you and I've thrown some words at you: riskless spread trades, riskless ratio calls, income method number 4, 5, 6, and so forth. The full story, all 12 income methods, the proper setup for the beginning, and how to evaluate bulletproofing your positions if you have an unrealized gain, is available in the blueprint. That's the only place where we discuss all 12 income methods, the original setup, controlling your risk from the beginning even. 41% of you said that just doing that one simple change, controlling the risks on your positions to less than 6% on any positions you open, would have turned a losing year into a winning year over the last 12 months. That's a game changer, isn't it? But the only place you're going to learn all the ins and outs of the proper structure, when and how to use the 12 different income methods, how to approach a limited risk position as you head towards earnings, and of course, the best ways and structures to lock in profit if you have an unrealized gain, is to pick up the blueprint. If you go to www.radioactivetrading.com/iridium, you'll be able to see the special bonuses that we're offering right now for the blueprint, including that Mastery Series video I mentioned, the Foundations of Radioactive Trading CD, the Fort CD, in addition to a free month of power options and a discounted first month of the Fusion subscription that we looked at with earnings trades as well. Okay, that's the only place where you learn the full information. You can see those special benefits, radioactivetrading.com/iridium. I'll also send to you, of course, here that chat window. Remember, you wanted to test out that insurance tool and plus see some of the other powerful tools we have for finding new positions in over 23 different strategies. You can take that 14-day free trial at powerop.com/RAT. Just put in first name, last name, and email address. You have full use of the Power Options site for 14 days, including the portfolio tools for tracking and managing your positions, and our patented search tool for over 23 of the most commonly used option strategies. But if you're serious about going forward in the next 12 months and controlling your risk to 6% or less, if you've been struggling and falling behind because of the leverage of credit spreads, where one loss is wiping out 8 or 9 previous gains, and although you were promised an 80% probability with 11% or 20% double-digit returns even on weekly options, but you're not seeing it and you're losing money, you might want to think of a different way. You might want to think of starting to limit your risk first with a guaranteed insurance policy, not assumed insurance like a stop order or a trailing stop after you have a small gain. And you can still do many of the option strategies you're doing right now, such as covered calls and credit spreads, and mentioned calendar spreads and ratio call spreads, but in the context of a position that can't lose more than 4 to 6%. And if applied right, following the guidelines and the rules in the blueprint, you can keep reducing that risk to where you can have bulletproof positions. We have a guaranteed profit to the downside, still the opportunity for unlimited upside profit potential going through earnings or any other black swan event. We don't know what the markets are going to do. We don't know if we leave the market on Friday and things are still stagnant with SPY and SPX, and we wake up Monday and everything's down 5, 6, 7%. Some stocks are down 12, 15% for any event that happened over the weekend. I'm perfectly comfortable there because I know my positions that aren't bulletproof are only going to lose 4 to 6%, even if my stock's down 15, 20, 30, or 40%. I actually had a trade last year that Iconics, I got in as a Mary put. I think my original risk was 7%. I was in a stock for about 5 months, and it was just a roller coaster of doom and gloom. The CEO left, or I'm sorry, the CFO left right before the first earnings a month after I got in the trade. Sketchy. Don't know if they were trying to force him to, fake numbers or whatnot, but he left a week right before the earnings announcement, and the stock dropped 12%. Then the COO left a few weeks after that. The stock dropped another 15%, and then it kept going down. And then before the next earnings, the CEO said he was going to leave. It dropped another 18%, and then the earnings came out and it dropped more. I stayed in the stock the entire time. It was down 65% in the 4.5 months I was in the trade, and I was long stock the entire time. Got out with a 4% gain, which isn't that great for a 4-month trade, 1%, but it beats 65% loss I could have taken owning the stock. The 15 or 20% loss I would have taken with a stop order in the first 30 days, or the 48% loss I would have taken had I tried to manage it as a covered call position. Using these techniques, reducing the risk, having the locked-in profit, being able to cancel that, and then taking advantage of the further downside, I was able to get out with a 4% gain. I was long stock the entire time and it fell 65%. So sometimes we brag about our losers. I was actually a winner, but I picked the wrong stock in the worst case scenario. All right, so if you have any questions later on, remember you can email us at any time to support@radioactivetrading.com. Of course, you can also call us during market hours. You can reach us at 302-992-7971. And I'm going to post the recording today. I'll send you an email when the webinar is recorded. You'll be able to access that at radioactivetrading.com under the free webinars tab as well. Okay, so if you have any questions about maybe your positions, or take that trial there and see what's going on, remember, send us an email, give us a call. We'd be more than happy to help you out. But in order to get the full story and to have this in your toolbox to approach these positions going forward with a controlled risk, the potential to bulletproof, or to potentially have no risk and still profit in both directions, radioactivetrading.com/iridium. Check out the bonuses we're running for the blueprint. Pick up the blueprints. Take advantage of that so that the next 12 months from now, if I ask that question, you'll be able to say that, well, maybe the keeping your risk to less than 6% wouldn't have helped you because it's already helped you, but you wouldn't have to worry about having a losing year turn to a winning year. You've already proven to yourself that was a game changer if you were in that category. So ask yourself where you want to be 12 months from now if I ask you that question again. Ladies and gentlemen, thank you for joining me this afternoon. I hope you all enjoyed the presentation. We will see you later on, later in the week potentially, for some of our different presentations we have. Happy trading, everyone. Good night.